So this is a show kind of devoted to real estate investors and some of the legal topics and business topics surrounding that. But I want to start initially with the question of structure for a real estate investor who's either starting, maybe they've already started and they're questioning how they've structured their business, their assets. From a tax perspective, how do you recommend real estate investors structure their business holding to maximize tax benefits? How should they begin thinking about that?
Good question. So the, I would the very first thing that I would probably want to make sure that people understood is LLCs and what that means in the eyes of the IRS. And ultimately, the answer is an LLC means nothing in the eyes of the IRS. And so LLCs are great legal tools, right? But the IRS doesn't understand what to do with them. So going up and setting up an LLC potentially doesn't do anything for you tax wise. It gives you liability protection right in the legal side, but it doesn't do anything tax wise. And so understanding that LLCs can be taxed a number of different ways, just depending upon how they're structured and set up and what elections you make. So LLCs being the primary business that I'm seeing people deal with, just make sure that you understand what that structure is or how the IRS is going to view it. The next step that I would say people need to understand is how the IRS taxes different kinds of income. Primarily, we're going to fall into two categories: active income and passive income. I have clients, and I don't know if you guys run into this, but they'll call themselves real estate investors and they're flipping homes. Well, that's
Sure.
great. That's totally fine with that. I feel great about flipping homes. Flipping homes, the IRS falls into this active category. And so flipping homes is going to be treated and taxed very different than holding a property for rents. If I am trying to wholesale a property, right, that's treated differently than holding a property for rents. If I am trying to buy a property and then sell it on a seller finance note to somebody else, that's treated differently than holding a property for long-term rents. So understanding what you're trying to achieve with that piece of real estate and what the intended purpose is will determine how the IRS is going to treat it. And that then determines what the best entity type is for that transaction. Usually or transactions dealing with active income will be best done from a tax standpoint out of an entity that taxes as an S corporation. That ultimately mitigates or allows us to pay the least amount of Social Security and Medicare tax. I'm going to put a caveat in here. If you're super close to retirement and you love the Social Security system, it's not a good fit for you. But if you think Social Security is not what it was originally designed for, I'll say it that way, don't pay into it, and the S Corp is the best way to do that. For long-term rental holds, those are usually best done in either what I would call a single member LLC or sole proprietor or a partnership, just depending upon what's involved and what's going on with the property.